Have you ever really stopped to think about something so basic to, well, everything global that we just take it for granted? I mean, the US dollar, its stability, its dominance everywhere. It's just been the default, right, for
Yeah.
ages. But what if that bedrock, that foundation, is actually shifting significantly? Today, we're going to dive deep into this really fascinating and, frankly, pretty critical discussion about the dollar's long reign. We've gathered a whole stack of sources, research papers, news analyses, expert commentary, and they all point towards, well, a drift away from the dollar. It's been happening for years, but now it seems to be speeding up, becoming this coordinated, policy-driven push from different countries. So our mission here is to unpack why. Why now? What's really driving these changes? And crucially, what could it all mean for you, for the global economy? We'll get into the geopolitics, these new payment systems popping up, the role of BRICS, why central banks are suddenly buying gold like crazy, and yeah, even how things happening right here in the US, fiscally speaking, are part of the picture.
And that's exactly the right way to look at it. Because, yes, the dollar is still number one, no question. Reserve currency, trade finance, FX markets. It dominates. But the direction of travel, that's what's changed. It's clearer, and it's moving faster than we've seen in decades. So let's be clear. This isn't about the dollar collapsing tomorrow. It's about erosion, a steady, accelerating erosion of that near-total dominance it once had.
Okay, let's unpack that. Geopolitics seems to be a huge piece of this puzzle, according to our sources. What exactly happened after 2022 that sent these, well, shockwaves through central banks everywhere, made them rethink the dollar?
Yeah, it really was a pivotal moment. Think about the freezing of Russia's sovereign reserves. We're talking roughly $300 billion held in G7 EU countries, just frozen. That was huge in itself. But then in 2024, maybe early 25, the G7 and EU decided to use the profits generated by those frozen assets.
Right, to fund that loan package for Ukraine, about $50 billion.
Exactly. And for other central banks watching, that was concrete proof.
Yeah.
It wasn't just theory anymore. Reserves held in the West, previously seen as totally safe, could actually be, constrained, used for geopolitical goals.
And it wasn't just the money itself being frozen, was it? It was also about access, right? Access to the system.
Precisely. Access to the financial plumbing, as they say. Dozens of Russian banks got cut off from SWIFT.
The main messaging system for international payments.
Yeah, the main highway. Getting kicked off confirmed that these vital dollar-linked systems, communication, settlement, they could just be switched off.
Yeah.
Politically. So if you connect the dots, if you're a central bank or a big state-owned company somewhere else, and you see that the safety of your reserves, your ability to make payments, might depend on geopolitics, well, you start to hedge. It's only logical.
Oh, they hedge them.
You diversify.
Yeah.
You buy more gold. You try to do more deals in your own currency or your neighbor's currency. And crucially, you invest in building parallel systems, new financial rails that will go around the dollar system. Right, which leads us perfectly into these alternative power blocks. These geopolitical tremors seem to be watering the seeds for groups like BRICS. What's happening there?
Well, BRICS has been busy, really expanding. They brought in Egypt, Ethiopia, Iran, the UAE in 2024.
Quite a diverse group.
Definitely. And then Indonesia officially joined in January 2025. Saudi Arabia's membership is still sort of pending formally, but the direction is clear. Get bigger.
And a bigger club means?
More clout. More critical mass to actually push for using local currencies among themselves, promoting non-dollar options for trade and finance across a much wider network.
And it's not just about adding flags to the group photo, right? Are they building their own financial muscle to infrastructure?
Absolutely. That's
Yeah.
key. Look at their development bank, the NDB, the new development bank. They've set a specific target. Roughly 30% of their lending should be in the members' own local currencies between 2022 and 2026.
So actively steering project finance away from the dollar. Explicitly.
Ah.
And they're already reporting about a quarter of their portfolio is in BRICS currencies. So this raises a really important point, I think. Even if you don't get a single BRICS currency, which is, complicated, just building this coordinated plumbing, lending, trade finance systems, payment networks, all designed to work in local currencies, that significantly chips away at the automatic need for dollars in a lot of international business.
Okay, so speaking of plumbing, these new rails you mentioned, our sources talk a lot about major changes in payment systems. Can you tell us more about those?
Yeah, this is where the tech comes in. China's system, CIPS, that's the cross-border interbank payment system. It's basically their alternative to SWIFT for yuan transactions. Scaling up really fast. Volumes jumped something like 43% in 2024, hitting 175.5 trillion RMB. Transaction numbers up about 24%.
Still smaller than Swift, but that growth is pretty rapid.
Is definitely something to watch. And then there's this other project, Mbridge.
Enbridge, right. That sounds potentially very significant. What is it exactly?
So Mbridge is run by the BIS, the Bank for International Settlements, and it's focused on cross-border central bank digital currencies, CBDCs.
Digital versions of national currencies, basically.
Yeah, issued by the central bank. The Mbridge platform hit what they call the minimum viable product, or MVP, stage in 2024. The initial group was Hong Kong, mainland China, Thailand, and the UAE. But then Saudi Arabia joined as a full participant in 2025.
Saudi Arabia. That's big, especially for energy markets.
Huge. It signals a real, concrete alternative settlement platform, particularly for those major energy trade corridors. Think oil moving east, settling it directly, potentially without dollars.
So this isn't just theory anymore. We're seeing actual non-dollar deals, especially in commodities.
We are. Real-world examples are popping up. China, for instance, has been settling most of its oil imports from Russia in yuan since the sanctions started. And India and the UAE, they set up a direct rupee dirham settlement channel. It's already been used for crude oil purchases.
That's fascinating. So once these alternative routes become reliable.
Exactly. Once major trade flows can move smoothly on these new rails, that old stickiness of the dollar, everyone uses it because everyone else does it, starts to weaken. Then invoicing preferences, collateral choices, they tend to follow the new plumbing. It creates this feedback loop, pulling activity away from the dollar system.
Okay, so let's talk numbers. Are these shifts actually showing up in the data? Can we measure this erosion?
We can see the momentum, yeah. Even though the dollar's overall share is still massive. For example, in 2023, the Chinese RMB actually overtook the euro.
Overtook the euro. And what?
As the #2 currency for global trade finance, specifically for letters of credit. Now, it's still miles behind the dollar, but climbing past the euro, that's a meaningful jump.
Yeah.
And then in 2024-25, the RMB hit #4 in global payments by value. It's hovering around, say, 4% to 5%. The dollar's still near 50%.
So perspective is important. Still dominant, but the challenger is gaining ground.
Precisely. It's not a revolution overnight, but it's a clear trend.
And what about the big picture? Central bank reserves, the money countries hold for rainy days.
Yeah, the IMF's COFR data that tracks the currency composition of official reserves. It shows the dollar share hovering around 57–58% in the 2024 early 2025 period.
Which is down from
around 70% 2 decades ago.
Ah.
So it's been a slow bleed, but the floor keeps getting lower bit by bit. Even the Fed's own review in 2025 acknowledged this trend, while still rightly pointing out the dollar's overall dominance. But if you connect this back, these are flow indicators we just talked about: trade, finance, payments. Small shifts there today, they compound over time into changes in the stock, the total reserves held, the funding basis. It's like a current slowly reshaping the landscape.
Okay, and hedging this perceived dollar risk. Gold keeps coming up. Central banks seem to be really leaning into gold.
They really are. It's been a record-breaking buying spree, over 1,000 tons annually from 2022 through 2024. And the buying continued strongly into 2025. You see countries like Poland, Turkey, Kazakhstan being consistently active buyers. This isn't just a blip.
And we know this is a conscious strategy, not just market noise.
Oh yeah. Central bank surveys confirm it. They explicitly state a rising intention to add more gold to their reserves and, correspondingly, reduce their U.S. dollar holdings over the next 5 years or so.
Why gold specifically?
It's seen as the ultimate neutral reserve asset. It isn't tied to any one country's policies, politics, or, importantly, fiscal situation. And when you think about what this says about the long-term trust in any single fiat currency as the sole anchor, especially now, it suggests that the combination of those geopolitical shocks we discussed and these growing fiscal worries is pushing countries back towards something seen as, well, fundamentally independent, a universal store of value. So this large-scale, consistent buying by official institutions, it signals a structural hedge against dollar risk, a real shift in thinking about reserve diversification, maybe even about the stability of the whole setup.
Which brings us to a really interesting, maybe slightly uncomfortable part of this. Challenges coming from inside the U.S. Our sources highlight U.S. fiscal health, the debt situation, as a headwind for the dollar itself.
Indeed. You can't ignore it. The U.S. public debt has climbed past $36 trillion. That's a huge number. And the cost of servicing that debt, the net interest payments there at or near record highs.
Didn't they actually surpass defense spending at one point recently?
Briefly, yes. On a year-to-date basis in 2024, interest costs actually edged above spending on both defense and Medicare. And the CBO, the Congressional Budget Office, Their projections show interest costs staying ahead of defense spending for years to come. That's a major structural weight on the budget.
And this hasn't gone unnoticed externally. We've seen credit rating agencies react.
That's right. Moody's downgraded the U.S. sovereign rating in May 2025. That followed S&P's downgrade back in 2011 and Fitch's in 2023.
And their reasoning.
Pretty consistent. Rising debt levels and the ballooning interest costs. Now, technically it's a small notch, but symbolically it's a below. It directly challenges that core risk-free narrative that's always underpinned the global demand for U.S. Treasury bonds as the ultimate safe asset.
So that makes you think the dollar's strength rests so much on the Treasury market's depth and trust in U.S. policy, right?
Exactly. When the fiscal math starts looking wobbly and the rating agencies are flashing warning signs, even if they're just amber warnings, reserve managers around the world notice. They don't necessarily panic, but they diversify. At the margins, they start looking for other options. They don't need a perfect replacement for the dollar, maybe just a basket of good enough hedges to reduce that concentration risk, even if it means shifting slightly away from what was always seen as the safest bet.
Okay, so we've painted a picture of significant challenges. Geopolitics, new tech, BRICS expansion, gold buying, U.S. fiscal issues. But let's balance the ledger. What hasn't changed? What are the dollar's enduring strengths? Why is it still king for now?
Oh, the dollar's moat is still incredibly wide and deep. You have to acknowledge that. The U.S. still offers, by far, the largest and most liquid bond market in the world. There's nowhere else to park that kind of money with that ease. Plus, a fully convertible capital account money can flow in and out easily. That's huge. And a strong, predictable legal system protecting property rights. Investors value that certainty.
And the actual mechanics of global finance.
Still dominant. In the foreign exchange markets, the dollar's on one side of something like 88% of all trades. It's just ubiquitous. And for global payments, measured by value, it's still involved in roughly half of all transactions worldwide. So no other currency, no other system comes close to matching that sheer scale, combined with that legal and market infrastructure, that predictability.
And the competitors, like the yuan or these new platforms, they still have their own hurdles to clear, right?
Absolutely. Take the RMB's international push. It constantly bumps up against China's own capital controls. They want the currency used more globally, but they're hesitant to allow money to flow freely in and out. That's a fundamental friction.
Makes sense.
And these newer platforms, like Embrid or CIPS, they're growing fast, yes, but they're still toddlers compared to the established giants like SWIFT or CLS.
CLS being the big settlement system for FX trades.
Right. Building that kind of global network effect, that deep liquidity, that institutional trust, it takes a very, very long time. You can't just flip a switch.
Okay, so looking forward then, for you listening, trying to make sense of all this, what are the key signposts? What should we be watching over the next, say, 12 to 24 months to see how this story develops?
Right. Practical takeaways. First, keep a really close eye on Embridge. Who else joins? What kind of transaction volumes does it handle? And critically, do we start seeing major things like energy invoices routinely getting settled on that platform? That would be a major signal.
Okay, Enbridge scale up. What else?
The BRICS institutional plumbing. Will the NDB actually hit that 30% local currency lending target? Does anything concrete emerge from talks about a BRICS pay system? And, of course, the final decision on Saudi Arabia joining the bloc? That's a big geopolitical marker. Also, watch the growth of CIPS, China's payment system, and keep track of those bilateral deals for settling commodities, especially oil, in local currencies like the yuan-ruble trade or the rupee-dirham deals. Are they growing, spreading to other commodities?
Got it. CIPS growth and local currency oil deals. What about the broader data?
Keep an eye on the regular IMF COFR data releases. Does that dollar share in reserves continue its slow downward creep, or does it stabilize or even accelerate? And watch the World Gold Council's reports. Do central banks keep buying gold at this elevated pace? That tells you a lot about their underlying risk assessment.
And finally, back home for the dollar.
Yeah, don't take your eye off the U.S. fiscal situation. Does that trend of interest costs potentially outpacing defense spending continue? Is there any serious, credible plan put forward for medium-term fiscal consolidation? Because that domestic picture really matters for the dollar's global appeal as the ultimate safe haven asset.
So, pulling it all together, what's the big takeaway here? It seems clear, dollar dominance isn't suddenly ending. It's not falling off a cliff tomorrow, but
Yeah.
Serious, durable challenges are here, and they're coming from multiple directions at once. You've got geopolitics pushing countries to actively build alternatives, new payment rails, more local currency lending. You've got these steady, measurable shifts in behavior in how trade is financed, how payments are made, how reserves are composed, plus gold making a major comeback as that neutral hedge. And then you have the U.S. domestic situation, the fiscal outlook, the credit ratings adding another layer of complexity to that old risk-free story.
That sums it up well. The dollar is definitely still first among unequals. It holds immense structural advantages, but that sort of monopoly premium it enjoyed for decades, that's clearly eroding. What the sources really show us, I think, is that optionality, having choices, having alternatives, that's becoming the new core strategy for how nations manage their finances on the global stage.
Optionality. That really sticks with you, doesn't it? If countries all over the world are deliberately building financial optionality for themselves, changing how they trade, how they invest, how they manage risk, maybe even how they interact, what does that ultimately mean for the shape of the world economy, for global cooperation, maybe even conflict in the decades ahead? That's definitely something powerful for you to mull over.